Hi, this is Randy Finney with the right side of the chart, and today is Tuesday, March 26, 2019. This is video number 2 today. I did one earlier on the cannabis sector, and I want to do a sort of an all-inclusive charts I'm watching video in video format today, just some of the things that stand out. We'll just briefly touch on the broad markets because there's really nothing new there. I made some comments in the trading room. I think there's a lot of maybe a little bit too much effort being read into these intraday price swings and intraday moves. I mean, the market's up strong today, 0.92% as I'm doing the video here, but it's all noise to me, at least. All nothing but noise. Up today, down tomorrow. Up today, down tomorrow. That's been the trend. Big intraday price swings. You know, we had price compression here, the small candles, and now one thing to note is volatility is starting to expand. You started with after the FOMC meeting last Thursday, we had that big green candle followed by a big red candle that took us below there, and so you can see the back and forth. And the bigger picture again remains that the market is still struggling. 1% gain in the S&P does nothing but to put us back here to back test that 282 level. We're still a little bit below that. Again, all I'm trying to say is, personally, I'm not reading too much into what happens here. I will once we make a definitive impulsive breakout of this range. Big green candle up above, big green candle below on a weekly closing basis, and that will most likely determine the next trend of the market. Maybe, maybe not. We already had one whipsaw, but again, that was intra-week. So let's see if we get a weekly close above or below. But again, that's bigger picture. I don't want to spend too much time on that. What is worth noting is this article. I mentioned this in yesterday's video. This came out, I think, yesterday in the Wall Street Journal. How traders are worrying about low liquidity in the E-minis. So they say liquidity is drying up in the S&P 500 futures, down to levels last seen in the 2008 financial crisis. So here's a chart here. Here's where we were at back then, 2008, and it was the end of the, heading into the end of the bear market there, which bottomed in 2009. So that's a notable trend. I wish they would have came to the left of this chart. I would have liked to seen what it looked like leading up to the market top and afterwards, but unfortunately that's all they gave us here. So either way, this is a concern. Now, what does this mean to you? Why is it important? Well, as the article goes on to say, when liquidity dries up in these futures, it increases the odds that you can have a big shock, a big move in the market. You don't have that liquidity, so when everyone's trying to get in or out of a stock or futures in this case, and these are the index futures, you have a rush for the exits and you don't have a lot of liquidity, it exacerbates moves to the upside or downside. So again, if you're a journal subscriber, you can read that article. I think it was yesterday. Kind of dovetails into the comments I made. Somebody asked in the trading room, when do you think we'll see the lows tested in December, the December lows tested? And then, of course, assuming that they are tested, I think they will be. It's quite unusual to see a single, sharp sell-off like that without that low being tested again. But if it happens, first of all, it depends largely on when this range breaks out and which way it breaks out. And again, going back to the S&P weekly chart here and just focusing on this trading range now. So here's the market, and go back all the way here to this candle. Let's grab this tool here. We go back and let's say this is our recent trading range. So now we have 1, 2, 3, 4, 5, 6. We're in the 7th week of mostly sideways trading, again defined by this box right here. So if we get a definitive breakout here soon to the downside, I think that those lows will be tested a lot faster than most people even think is possible. And I'd say as possibly as early as the beginning of May, early May sometime. Why is that? Well, number one, stocks tend to fall a lot faster than they rise. You can see that here, you can see that here, here, and here. And you can go back 100 years if you want to, and you'll see the same thing. Stocks usually, when you get a correction, especially a bear market, you will see weeks, if not months, of gains wiped out in just days. That's the norm. So again, it all depends on when this range breaks out. If we trade sideways for a while, obviously we're not going to hit that that early May window. I think I gave a window early May through late July, and that's a big window now. Why? Well, because I don't know if we're going to trade sideways for several more weeks or we're going to pop above it. If we pop above it, let me say this now very clearly, that does not eliminate the possibility or likelihood that this low gets tested in sometime this year. We could pop above it. We could fail before the previous highs. In that big drop we had back in 2015, we came back up almost to the previous high and then had another leg down. So we could certainly come up. Anything is possible. And we could fail just shy or just above. And like I often say, when all eyes are watching a key level, one of two things will happen. You're either going to reverse just shy or you're going to pop above it and then reverse. So far, that proved to be the case on this level. And I said that long before we even got here, that we probably wouldn't reverse right off it. It was my max upside target, that we'd either pop slightly above it, then reverse, or fall shy of it. So far, that's been the case. We popped a little bit above it, but we haven't failed at that level yet. We're still fighting it. The market's still testing it. So again, that would kind of look something like this, and it depends on more so when the bottom of this range is undercut, if that happens. So if it were to happen soon, then I think at best early May, that would put us somewhere right here. That you can see the months, and possibly as late as maybe mid to late July. And that would entail more of a zigzagging down in the beginning. I gave some other levels on the daily chart to watch, support zones, target areas. So I think, again, and this is maybe getting a little bit ahead of myself because we haven't even broken out of this range or failed this resistance yet. But, I see it working something like this, zigzag down, and then increasingly impulsive selling as we hit these, break below that orange and red level there. And then again, of course, that's just a guesstimation, a forecast based on where things are today. If we pop to the upside, if we burn through these divergences down below, pop to the upside, make a run at the previous highs, then of course that would put us later in the year, even if, that's a big if, assuming that we're going to go and test those lows. Okay, I want to kind of tie in some of the recent trades, both active right now or not, either official or unofficial, I should say, or those that were stopped out, like QQQ. We've had a series, unusual, unprecedented series of stop raids and trades stopped out on the broad markets. But again, I'm trying to position for what could be a triple home run, even a grand slam, if those lows are going to be tested. And like I said before, I don't think we test the lows. I think we undercut them. If the market gets anywhere close to the December lows, I think it'll just keep on going. Do not pass go, or pass go, do not collect $200, whatever that was with Monopoly. I think that's what it'll be, is just a move down through there. So therefore, we're talking 25+% drop, and I'm willing to take these 2 to 3% stops on these QQQ trades, and hopefully catch a runner trade, because again, it's still priced into the chart. So let's just look at let's look at that trade. I'm not moving it into the completed category trade because I don't want these. I'm going to maintain these targets as of now. And once I move a trade to the completed trade, that category, it's not locked down. Those posts can be viewed, so I'm holding off. So what happened here? This is the QQQ recent short trade. Stop was hit right here. This was at FOMC noise. Personally, as I said, I usually suspend stops on Fed weeks and I don't take breakouts. But we have to. I left that stop in place, and I did it on purpose, and that's fine. We're out of that trade. But remember, with that range I just showed you on the S&P for weeks now, this is what's going to happen. You're having these big moves up, down, swing trading, especially on the broad markets or any stocks that have a high correlation, is nearly impossible, whether you're trading long or short. If you were trading long side, you've had plenty of drops, especially in the S&P 500 in recent weeks, that most likely would have cleared out your stops. So where we're at on this one, 60-minute chart, there's the divergent high. We're still trading a little bit above where that last QQQ trade was stopped out, and I'm certainly watching it and considering another entry again It's up to you guys whether you want to take it or not. But here's what it looks like to me on the charts. So we have this uptrend line on the 60-minute chart. We had another divergent high recently. We're back testing today. So I can say this emphatically. This looks like an objective level to short. We had a breakdown following a divergent high on the 60-minute chart and the daily. Much more importantly, this was also right here a divergent high on the daily, and then a back test of the trend line that we broke down. So that's about as objective as it gets. PPO trend indicator has crossed to bearish. There's a second check mark. So and believe me, it may come soon. I may add that trade back soon. I just wanted to kind of let you guys know what I was thinking right now, where my thought process is, and that's what looks like on QQQ. And I've already shared some of these targets here. And again, I'll, if it comes back on as an official trade, I'll study this chart and look to see if I want to revise any of these targets. And I'm still, like I said, open to a lot more. So if I do add it back, I'll have some near-term swing targets, and depending on how things develop, if the SPY makes a pretty impulsive and convincing failure at that level, then I will most likely extend targets and add additional targets down here. And that's why we're looking at, let's say I use another 3% stop on it, and we're looking at a 30% profit target. Potential on the downside, that's a 10-to-1 RR. Doesn't get much better than that in trading. So we'll see. All right, so that's that. There's QQQ. Again, a bunch of noise today, back and forth. This is what the market looks like intraday. This is where you're going to get chopped to pieces if you're trying to trade within a trading range. Market goes up, down, then it gaps up. Some big runs today, intraday swings. Now it's dropping. It's starting to enter the gap. When it enters the gap, it'll probably backfill the gap. So again, another objective short entry on QQQ. On that back test there. And of course the semis have been whippy as well. This is what happens. I couldn't have foreseen this. Well, again, yes, the Fed, this is what I talked about before it happens. Every year, for years, I've talked about this on potentially market-moving FOMC meetings. This is what I call FOMC noise. There's the big green candle from the Fed day, the fade afterwards. We're still below where we were then, but what that did is it took us out of that trade, that SOX short trade, by just a hair. And again, I know a lot of you have said in the trading room, and I've known this, suspended your stops or held off, and good move, because I still think this trade looks good. I'll stick with the official stop, and that is technically considered stopped out, but I will most likely add this one back because I think there is a tremendous amount of money to be made on the next downtrend in the semis if the sector has indeed topped, which I think it. Here it is. It's just a slow roll, like a lot of market tops. This was the peak back here in early 2018, and so far the semis are still at or below that level there. Let's try to put a line on it right there. There it is, a little below that level with negative divergence. And so that's been the trend here. There's your divergence right here, divergence lines with that most recent high, just like the daily chart. We just have to get out of this range. We have to probably undercut this recent low to get going, and it would certainly help to fall back below this trend line. This trend line's been chopped through several times now, so I'm not putting as high a weighting anymore on it because it's been traded through so many times. So that's SOX, and let me see what else I wanted to cover. Well, on a related note, XLK, like I said, the market doesn't die until tech dies, and XLK, like I always say, will almost mirror the charts of QQQ. So you had a divergent high, divergent high, divergent high, negative divergence there. So we have divergence on the PPO, and I don't see why it'll be any different this time around. We don't always have to have corrections after divergent highs, but they usually signal major trend changes. There it is. So tech looks to be on its final stages of the rally. In fact, this was probably the top, that post FOMC, that big green candle there, which was then faded afterwards. And again, we didn't have it on the RSI, the negative divergence, but what we did have is an extreme overbought reading. And let's show you how extreme it was. Put that line right there. The last time that the semis were this overbought, and remember, this was these were also bull market readings. This may just be a bear market rally. We had one there, or was it right? Oh, that was divergence right there. You had two consecutive readings right there that gave us the negative divergence on the semis at that point. And then you can see there, divergence right there, overbought reading, correction, divergent high correction, divergent high correction, and divergent high correction coming up. And with tech being the biggest top weighting in the S&P 500 and by far well over half of the NASDAQ 100, like I said, if these charts play out the way they have in the past, the market's going down. There's just very little question to that. Again, if XLK goes down, very little question that the broad market will follow, because that's a big part of the broad market. All right, next up, XLF, one of the largest sectors in the S&P 500 as well. It happens to be lacking in the NASDAQ 100, but again, big component of the S&P 500. And you know, it's pretty clear. You know, the financials are in a bear market. They're in a confirmed downtrend. There's your series of lower highs. Here's your series of lower lows. That is by definition what a downtrend is. They took it on the chin from the Fed's, extreme dovish stance, like I, answered that day when somebody asked, aren't low rates good for the economy? Up to a point, but not. This is crushing the banks. And again, these low rates are because the economy is rolling over. That's why the Fed took that extreme dovish stance. Make no mistake about it. It's not, Powell finally cowing down to Trump. The Fed is concerned about the economy. So there's a well-defined support level, and nothing falls forever. We had a heck of a correction so far. That's a very solid support level there. It was a former Fibonacci 38.2% level, as well as price support around $25 or so. And we fell to it, and we're consolidating, but we haven't bounced, and it's this divergent high that says don't try to game the bounce. We just put in a divergent high, so even if we bounce, any bounces from here to me are shortable at this point in time. So there's the financials, again hitting on that more so because it speaks to the broad market. Let's see, and then of course, as I talked about earlier with the futures liquidity drying up in the E-minis and the potential for a swift move down. If we get it, this guy can be explosive. This is TVIX. This was an official trade recently. We went up. We hit our first target right there. Trying to grab a circle tool here. Hit our first target. Then it pulled back, took out the stop. But from there it went on and it just extended the existing divergences. We had bullish divergence here at the lows that preceded that rally, and those divergences have not been negated. They've only grown larger to that most recent low. So again, whether TVIX comes up here to any of those other additional targets that weren't yet hit, or that potential third target, will almost certainly depend on what happens here with the S&P 500, how it resolves this resistance level that it's been struggling against. If we get a failure and the market starts to move lower, then you would expect TVIX to start to move higher. Alright, a couple other charts to look at here. Let me move this one out and resize this a little bit, get it all the way out here. Here, let me pause. Okay, there we go. This is just wanted to hit on the NQE minis. Just showed you the same thing on the QQQ chart. There's that uptrend line we broke down the other day. I said we back test it today. It doesn't get much more objective than that. Not just that you back tested a trend line, but you had again negative divergence on both the daily time frame as well as the 60-minute time frame at that high. So there's your breakdown. If you missed that shorting op, this is your second op. No guarantees in trading, but you short a back test. If this is your entry out on point, you can just set a stop a little bit above in case this just proves to be another whipsaw signal like this one here. That doesn't mean we've had a lot of whipsaws in recent weeks. Doesn't mean they're going to continue forever. If you want to wait and see which way this market breaks, fine. If you want to tactical objective entries here for shorts, whether it's just a a brief pullback trade. You can target, I can tell you right now, 72.05 right there looks like a good target for a swing trade, or this level here, even if you want to go for really small profits, 72.88. It's a decent move if you're, especially if you're using NQ, with the leverage factor involved. And the other one too is IWM. A lot of juice in this one. Get a lot of bang for your buck. Remember, we put in that 60-minute divergent low recently, so we've had a rally off there, and it was confirmed since I highlighted it the other day. It was the first time I highlighted it. Here it was unconfirmed divergence, but we've since made a bullish crossover, and IWM has rallied, but right into resistance. You can see right here today where we stalled so far. We had these reaction lows right there, about 152.50. We had some reactions there as well. So if this is the beginning of a larger downtrend, then what'll happen is bullish divergences tend to either not play out at all or play out for much less than expected. And what I mean by that, if it's if this market's going to new highs, if the S&P is going to break out, then you would expect this to be a great buying positive divergence on the 60-minute chart. However, if the SPY is going to fail here, then this little rally we had, it was decent, it was tradable, but let's see, percentage terms, what was that lift? About 3%, not even, about a 3% pop in IWM. That may be all you get out of a divergent low like this. And I'll tell you, you'll know what type of market we're in if we fade this pop and we undercut this level right here, 147.58. If that happens soon and the divergences don't play out right here, these big divergences, if they don't play out for more than a 3% pop and we do this, that's bear market action. At least that's primary downtrend action. It means that this top right here, that big divergent high we had there, and this little smaller divergent high here, means we're probably going to continue lower on IWM. Bullish case, these divergences hold. You'll probably need to see the S&P take out that level it struggled with. And then here's your target right now. If you're long and bullish and you think the market is going to go higher, there's an objective target. You want to watch that downtrend line, and about the 156 level as a breakout above that would certainly be bullish for the small cap stocks. Okay, and let's just conclude this with a couple commodities. This one's an official trade. This is wheat, the wheat ETN WEAT. Personally, I'm trading wheat futures. I actually took profits on my wheat futures today, but more of a just a quick tactical trade because wheat futures are at resistance. I'll get to that in a second. And this is why I post a lot of charts on the futures. Remember, wheat. This ETN it is tracking wheat prices through wheat futures, but as an ETN, it's much less efficient than a pure play. If you have the experience or the money, futures are a better way to go than these ETNs. But if you don't, you can buy wheat through any broker because it's an ETN. It'll trade on just about any brokerage platform. We do have potential divergence forming. That's one thing to note here. That may be the catalyst for a pullback. Not really so much on the RSI, and there's a downtrend line. But let's more so focus on the charts of the futures here, and we'll do that in just a second. So there's an uptrend line to watch. That's still our first target. Let me say this. At this point in time, I think the odds, we've had a pretty nice and fairly steady advance. I think we get a pullback soon, possibly, maybe not, but that's all it is. I'm going to leave that stop as is for now. If we hit the first target, I'll probably ratchet the stop up. So, in other words, before we hit T1, we'll probably get a decent correction, and I'm just looking to, maybe buy back in on a dip or a reaction off this resistance level in the futures. Let me show you that right now. Let me grab that chart. It would be under this charting platform here. I have it marked up, and then ZW, which are wheat futures. There it is. This is a level. Again, these are levels. I think when I originally posted the trade, I showed you this chart. We had bullish divergence down here. See the divergence lines on the 60-minute chart of wheat futures. Nice clean downtrend channel, descending price channel, and just beautiful price action since. Breakout was an impulsive breakout, and back test, perfect back test, and we've been moving up steadily higher since. Nice uptrend there. Let's try to do another tool here. There we go. There's our uptrend line, and here it is. So we have a pretty decent resistance level right here around 475 or 476. So again, I'm just looking to hopefully, ideally, recycle back in. If it continues to move and gets clearly puts that level in the rearview mirror, I might have to buy back in at higher prices. But that's just me micromanaging a trade, a swing trade. I still think, especially for the longer term picture, a lot of upside in wheat and some of these other ag commodities. Okay, here's the when I first posted wheat as a setup. That was back on March 12th. And here's that chart. Let's pull that down a little. Zoom it in. There we go. All right, so what was the logic? Okay, the reasoning was based largely on that 60-minute chart, also the daily charts, but as far as a long-term trade, which I added wheat as well, that means a trend trade, something that I might be able to tuck away for months or more. Here's a very long-term trend line. This goes back to the 90s. You know, right here, pre-2000. So what we're looking at here is a very clean uptrend line, long-term uptrend line. Wheat had fallen to that trend line, put in a divergent low right here. So number one, wheat entered, in my opinion, a bull market right here, and I pointed it out at the time, the last time we hit that level. There was a long-term, I think we even traded it. So this was the bottom in wheat so far. And again, that was that long-term trend line. So wheat has been and is in what I believe to be a new bull market. It's in a secular bull market because this is your uptrend line, but you have these cyclical bull and bear markets within. So we're just coming off a cyclical bear market into that low, but since then we've been moving higher. We've been making higher lows, and more importantly, look, this trade, like any, will either play out or not, but this is about as objective as you get. A pullback to that long-term trend line. Also, while overbought, you can see I have the circles there, and you can just follow prices up and see what happened every time that we hit overbought on this weekly time frame. So there was the basis for the long-term trade, and the fact, oh well, that's then, this is now. So when was that? Did I say March 12th? Okay, let's look at today's chart, and here it is. Okay, and so this is today's chart through yesterday. Actually, this is an end-of-day chart. Stock charts just gives you the futures end of day. So far a nice clean reversal off that level, right on cue. So you know, there it is. There was the bottom. Here's the reversal so far. This is what I was trying to draw, and you can see the RSI moving up off that level as well. So that bodes well for the longer term picture. And it's nice that we tagged it and moved up right away. Here we tagged it and we hugged it for a while. Here we kissed it and moved up pretty quickly. And so ideally we want to see this move up. And you know, as far as long term trade goes, you know, we could be looking at a move, you know, easily up beyond this previous reaction high, and that'd be a pretty nice move there, and quite possibly beyond. And another official active trade right now that we have is coffee. You can trade the futures, that's symbol KC /KC, or you can trade JO, the ETN. Be careful with JJOFF, which is the older one version that's being phased out. Liquidity is drying up. Some days it does move more, but you know, that ETN is being retired and replaced by JO, the one which is our official trade. JO has been testing, you know, getting close, very close to our stop. Hasn't stopped out yet, but that's a trade that's also, I'm playing the long game on that one. At least I'm looking at it that way. You can see my chart. Again, this goes back beyond 20 years, and pretty simple stuff. You can see here divergent low right there. There's your positive divergence, and just trade these trends. You know, there's your divergent low, there's a bullish trend. Here's a divergent high, bearish trend. We didn't really have divergence at that low, but we did have a nice clean divergent high with a trend line break there. So that's it. So if you want to look at it this way, here's our divergent lows on the weekly chart that we've had for the past 20 years, including this one right now. And this is strong divergence building. This was relatively, and we traded that. We nailed we got a good percentage of that run. We were right in on the bottom, and caught a lot of that on an official trade on coffee. And you can see how explosive some of these commodities can be when they run. So this one had its failure to launch so far. It continues to work its way down here, but the divergences are intact. So I can tell you this now: if they stop this trade out, so be it. I'm going to keep my eye on this one, and as long as the charts look constructive, if we get some buy signals or another objective entry, I will add it back. As of now, the trade's still active, so let's just see what happens with it. But I just wanted to make mention, based on the long-term charts, this one looks good and has a lot of promise. And you can see, potential targets here. And that was when we were back here. So now that's above a 50% gain if that target's hit, and probably above an 80% gain if that target's hit. Here's that official trade, JO. You can see there. Talk about trying to run at my stops. We hit a low of 33.60. I have a stop on a daily close below 33.60. So far they haven't taken it out. Here's what we need to do. We need to take out that downtrend line. I put a little more focus on the futures charts than I do these ETNs. But again, I know a lot of traders don't have access to futures, so that's why I use the ETNs as official trade ideas. But there it is. That low, by the way, even though this trade again hasn't panned out yet, here's our first target up here. The divergence, the same reason we bought it before with the divergent low, those divergences are only extending. See the RSI and the PPO coming up, making higher lows with prices making lower lows. That's positive divergence. Just tells me that if we can get a reversal soon and break out, that the ensuing move will only be more powerful as long as those divergences remain intact, especially if that weekly chart plays out. Okay, finally, and I've mentioned this one quite a bit in the past. It's sort of an unofficial trade idea, but I've said if you don't want to try to put together a portfolio of the best looking individual commodities, then you can use DBA in lieu. DBA is kind of a one size fits all to get exposure to the agricultural commodities. There's, you can see the holdings in here: live cattle, soybeans, sugar, corn, coffee, wheat. So it's an overlap, and that's one reason I haven't added it, but I may add this as an official trade because it's, I'm a big proponent of asset allocation. There's been so much focus on the broad markets lately. Broad markets have been going nowhere, but you can see commodities have a little stealth rally going on here. And I pointed this one out back here at the divergent low. It's been moving up steadily higher. It's taken out the downtrend line, which is this bullish falling wedge pattern. Big divergence there on the daily chart. So if somebody said, Randy, you cannot do asset allocation, you can't diversify, you have to pick one sector or one ETF and put your money in it and sail around the world for 6 months and come back, or a year, it would be this 10 times over before I'd put it into the stock market, SPY, or anything like that. I think the risk reward is much more attractive, and more importantly, the downside risk. If this, these have already been in a pretty vicious bear market, and these are commodities. They're not going to go to zero. They're not going to declare bankruptcy. The CEO isn't going to get caught in a scandal because there is no CEO to wheat and corn. These are things that the world needs. They're always going to be there. So whereas the stock market could crash 50% from here, just like it did in the last bear market and the one before that, commodities are probably not going to drop 50% from here. In fact, they've already come down quite a bit from where they were. A lot of those trading on long-term support, like coffee and wheat and things, or wheat, like I just showed you. So again, do you put all your money in commodities? No, because you don't have to. That's the beauty of it. Asset allocation says you have some money in bonds right now. Treasuries looking better. I'll need to get to that. There's some divergence in treasuries. Instead, I'd wrap the video up here, but I'm watching that. So I've been bullish on treasuries for since last fall, but we'll have to watch these divergent highs building. I mentioned the breakout recently in TLT and IEF, but I'm looking at these negative divergences, and I can just say this: at this point in time, if you weren't already long, I may not be adding a lot to it or taking new positions. I still have a good deal of my 401k money, long-term funds, and treasuries. But at this point, even though we broke out the other day, I'm just kind of holding tight and seeing what happens here. If we start to reverse, especially if that recent breakout fails, in other words, we move back below about this level here on IEF, that's not going to be good. So, even if we come to back test it, here's the thing, guys. We may just back test it and then rally, that would be bullish. But the back test itself, should we come down here, that's going to roll down this PPO and the RSI, and it could confirm that divergence. So let's just say right now near term neutral. We broke out, which is bullish, and as long as the breakout holds, that's good. And remember, divergences, these are only potential divergences. They could be burned through should treasuries continue to rally. Those divergences would be taken out, and that would be very bullish. So I just want to kind of say that, if it makes sense, that I wouldn't be diving into treasuries right now. Hopefully you already have a portion of your portfolio in those, and if not, you could certainly take a starter position here, but I just wouldn't go heavy at this point in time. In other words, if you had 100% of your 401k in the stock market and you figured, okay, now's a good time to pull some out, I wouldn't put 100% into Treasury bonds, if that makes sense. All right, we're going to wrap it up here. This has been Randy Finney with Right Side of the Chart, and I hope you enjoyed it.